All right. Today is Wednesday, 9/11/2024. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. Look, we have important things to talk about because the action today was throwing everybody all over the place. And of course, unexpected. So what really happened? Because we got the CPI, and we got a certain impression about Fed rate cuts and what's going to happen from here. But then the market acted in a completely different way than everybody's expectations. Let's try to decode the message and, most importantly, talk about how we can play it. We begin, of course, with the CPI. CPI came out right off the gate. And the reading is pretty much as expected, but there is one problematic reading, which is the core CPI. It came out a tick above expectations month on month. Expected 0.2%, we got up 0.3%. The bottom line is, you have inflation that is still going on, positive. I know the media loves to talk about soft landing and all of that garbage, that inflation is done and all of that. But you gotta remember, back in 2007, same time, when the Fed began cutting rates, inflation was negative 0.4% month on month. We got a 50 basis points. Now we have core inflation up 0.3% month on month. So right off the gate, the question becomes, is it really time to cut rates or not? Because there's a lot of risk that we could reinflate the economy again. As we got back in 2007 with commodities inflation, now we have housing inflation. And the component that led to the beat month on month in core CPI was shelter. Rationally, if you just look at it from an academic way, if you have inflation in the housing market where prices are reaching all-time highs, where supply is tight, the aggregate demand is high, every time we see mortgage rates going down, we see mortgage applications exploding higher. Just by that alone, academically, if you say, do you cut rates under this environment? And the answer would be, are you insane? Are you out of your mind? What do you think will happen in the housing market if you begin cutting rates right now? And furthermore, if you look at super core CPI, the biggest gain month on month, going back 3 readings ago. So again, we still have an inflation problem. I know nobody wants to talk about it. Nobody wants to believe it. And a lot of shitty people, let's just put it that way, to be nice. They come out on TV and they talk about inflation. Oh, the Fed defeated inflation. Honey, I can't wait to see the rate cuts. I can't wait. And I want 50, not 25. I want you to see with your own eyes what will happen to inflation. If you think this movie's over, we are just warming up here. The disaster will happen in the revival of inflation, and that's coming, guaranteed, 1,000,000%. And after that, it's over. Forget about it. There's no way the Federal Reserve, Janet Yellen, the federal government, nobody will be able to rescue the economy because we got the storms, 2 storms, inflation and a recession hitting at the same time. A lot of people don't want to believe in stagflation, but these are the warning signs that we look at all the time. The bottom line, folks, inflation came a tick higher, still as expected, but a tick higher, enough to erode all of the odds for 50 basis points. So you can see the odds for 50. I mean, at some point, it was the predominant odd. It was over 50% that we're going to cut by 15 September. Now, it's pretty much eliminated. Not going to happen unless we get another disastrous reading from retail sales. Maybe we can bring back the 50. But right now, the consensus is the Fed is going to cut 25, not 50. Forget about it. Isn't this bad news, right? Isn't this the kind of news that we dreaded? That if we get 25, not 50, with the recession warnings that we got yesterday from the banks, with all of the recession data and slowdown in the consumer we've been getting so far, isn't that an undesirable outcome that should freak out the market? So why the opposite reaction today? Why did the market rally higher? One step at a time. Let's begin with the bullshit excuses and explanations that I heard today. Bullshit explanation number 1. Oh, it's the Kamala optimism because she won the debate last night, so now the market is happy. If that was the case, how come the market didn't rally overnight? How come the market didn't rally upon the open? Why did the market puke initially? Because in the beginning of the day, we got a puke, a massive one, with the VIX moving higher. Everybody thought down we go and all of that, and then we got a reversal. So doesn't make sense at all as an explanation. Bullshit explanation number 2. Oh, it's Jensen Huang of NVIDIA said something. That AI demand is still intact, and that's why the market went higher. Or NVIDIA optimism. Well, we got Larry Ellison just with Oracle earnings said the same thing. And all of the media, all of the analysts, all of Wall Street is in consensus that the AI mania is still here and demand is hot, and NVIDIA is actually undervalued right now. How come we didn't rally yesterday or the day before? Why today? It's a bullshit explanation, and it doesn't make sense at all. What happened today, if we look at the 2 to 10 year spread, aka the yield curve invergence steepening, when we tick higher, so I'm plugging the candlesticks together, it might be a little confusing here. But the brighter candlesticks, that's the 2 to 10 ratio, and the other one is the index, the Nasdaq. We can see the tick by tick. So today, we went higher in the 2 versus 10, and we see the market also following through and moving higher. In a nutshell, this is why we went higher from a technical/mechanical reason. But what is the, let's say, a real-life explanation? Why did we go higher? The answer is the shorts who've been shorting, let's say, since the before or at the beginning of the month, who are sitting at profits right now. They decided to book their profits and cover their shorts. How do I know that? Look at the volume that we got today. We got higher volume. Look at the closing of put options in the money today. A lot of them got closed. And what name rallied the most? Well, the most shorted name, at least recently, Nvidia. They got out of these shorts. Now, the question that we have to ask, why did the shorts cover? That's going to remain the mystery. We can talk about this a little more as we expand the conversation. But folks, we got to talk about something here. You know that scene from Jerry Maguire? Help me help you. That's what I'm asking you. Help me help you. When I put all of these morning briefs and guidelines on the charts and all of that, and folks ignore it. And then they ask me questions about what do I do with this trade now? Do I open shorts? Do I open calls? What do I do with this? What do I do with that? My first thought is, are you not listening or paying attention to anything I've been saying before? Because the majority of trading mistakes are not a result of you and I being lousy traders or anything. The result of these mistakes, the majority of them, is psychological in nature. For example, let's go back to the beginning of the month. And here's your homework. Go back to the videos before September. What was the line, the confirmation line that I gave you in the SPY? That if we break this, we got a bearish confirmation. Well, we broke that. And since that point, we went down big in the market. Why didn't you take action when we got that confirmation? Why did a lot of traders, as I noticed in Discord, waited all the way till Friday? Last Friday, that is, the big flush, at the end of the day, to begin to open new shorts. Mistake number 1, ignoring the guidelines. Not having any technical guideline to follow. That's mistake number 1. Mistake number 2, lack of decision making. The market looks that it's going to go a certain way, but it gave you confirmation. You're too scared to take action. And by the time you see the initial move happening, such as Monday of last week, big flush down. Now you have FOMO and you want to open new short positions. But you're too scared because the market is now oversold. Maybe you got to wait for a rebound. And a rebound doesn't happen. We get a stall of 2 days. You don't take action. Then comes Friday with a big flush down. Then you take the action. A little too late. And the same thing is happening right now, where we do have a confirmation finally from bullish to bearish. And we have to adapt to the technicals. You got to respect the technicals in the trading game. Anything can change tomorrow. We can wake up tomorrow and all hell broke loose because of the Japanese yen or whatever, fill in the blank. The PPI, who knows? But we have to follow the technicals because that's the only clear guideline that we got. And the last thing you want to do is the same mistake on the upside that you made in the downside, where you have the confirmation, but you refuse to enter because, things went too high in a short amount of time right now. Things are overbought. I don't know, we might go down again. And then the market goes higher in tomorrow's session and you don't do anything. Then it goes higher again on Friday. Then you begin to buy some calls and you close your puts that are worthless right now. And next thing you know, Monday we open and we flush down again. And you're always late to the trade. That's going to cost you a lot of money. So if you're facing this kind of problem, you got to take a pause and reflect a little bit. Why am I being too late to the trades? What's going on here? Am I not listening to the confirmation? Am I not having pre-trade guidelines that tell me, okay, this is the time to open a trade. This is the time to cut loss. This is the time to hedge. If I'm not following this, maybe I need a little more of that. If I'm facing a psychological problem where I'm too fixated and overbought and oversold and I'm afraid to enter, maybe that's the problem right there, that I'm too fixated on short-term charts. I'm just looking at the 3 minutes or the 5 minutes or even the hourly, and I'm not looking at the big picture and the confirmations that we have in the daily and the weekly charts. You gotta take a pause and reflect on all of that because so far, if you made these mistakes, it's okay. You didn't miss out on the big stuff that's about to come. Now, as the Fed begins to cut rates, we will see episodes of volatility that we haven't seen in the last 2 years. They're going to be really aggressive, and a lot of money will be made for them. So you have to fix these mistakes before we move on to the next period of trading, where we're going to have a lot of juicy stuff to capture. But we have to address the mistakes before we do that. Example, let's talk about this NASDAQ future hourly charts, and I gave you the guidelines. If we have 18,428, if we lose that, confirmation open new shorts. Then we have 18,644, that's the bull to bear advantage line. It just gives you who has the advantage in the hourly chart. But so far, all the way to that point, the odds on the daily charts were about, let's say, more than 70% that we have more downside versus 30% that we go higher. Today, we flipped these odds. Why? We're trading above 18,730. That was layer number one, that if you have shorts in October and November that you opened last week, you need to hedge those via using calls for this week. And traders who've been disciplined, I mean, look at this trader right here. He has October puts on the IWM on NVIDIA, but he decided to go ahead and buy some of these hedges for September 13th, this week's expiration, and his loss on the October 18th stuff, specifically in NVIDIA. You see the 100 puts was down about 65%, but his hedge was up about 500% today. So folks, when I say hedge and we talk about these ideas, these things matter. You gotta take them seriously. The discipline pays. Okay, had we went down below 18,730 by the close today, would have said, okay, the hedges are done. Now we go back to the same odds that we got before. That we have about 70% plus chance that we go more to the downside. We're just waiting for the break of 18,428. That didn't happen though. It was jittery. Initially we went down. It looked like we're going to do that in the beginning of the day. Then we got a massive move higher with a lot of volume showing up. And we even closed above 18,825.75, which was our confirmation to short last week. Okay, if we're trading above the confirmation line to short from last week, what do we have to do with those shorts that we opened based on this confirmation? We have to do the opposite. It's time to close them. It's not pleasant to book a profit. It's not pleasant if you close the trade and the next day the chart goes down again because today was a one-day phenomenon. That's a possibility. But you gotta abide by some sort of a guideline. And the close today was not a tick above 18,825.75. It was way above. We closed even above 19,200. Again, I think it's excessive. We might get a pullback, but at the end of the day, there was a message from today's action that the shorts decided to cover. That's where the volume came from. And the shorts, usually when they buy and cover their shorts by booking profits, that's the first type of buyer. And they create a big initial move like this. You might get a dip after that. But the action that we got today, in a psychological perspective, what does that do to folks on the sidelines who've been waiting to buy? Now they got FOMO. Oh my God, see, NVIDIA is now up 6%. If I don't jump in right now, I'm going to miss the other 6%. And the initial short covering, whatever the reason behind the short covering was today, that could initiate FOMO by those on the sidelines. And we see more and more gains. And that is too much of a risk for us to hold on to short positions for October. Because what if we go another 2-3% to the upside? So the disciplined thing to do is you close these put positions October, November, because we got confirmations to do so. If we go down below the confirmation again, sure, we'll put them back in. But you got to remember, you can always get back in the trade, but you cannot recoup lost ground. Really hard to do that. Now, are we saying that we switch all in bullish now? Higher we go, all-time highs? No. That's not what I'm saying. Matter of fact, let's look at the guidelines that I gave you today step by step. Let's begin with the morning brief. I know you guys, some of you don't like when I read the morning briefs, but you got to understand, majority of viewers are not really Discord members, so they're not getting this information. I just want to be on the same page. So this is why, especially today, I gotta read it. And it goes like this. Good morning. The CPI came out in line with core slightly higher than expected. Shelter came out hotter while other categories cooled. The reading seals the case for 25 basis points, not 50. And the Fed Watch tool now reflects that. On face value, this should be bad for sectors that were betting on larger cuts, such as regional banks and small caps. And you might have noticed that regional banks and small caps were the laggards today. They only came back at the end of the day. Why? Because the shorts were covering at the index level, and they kind of pushed everything higher at the end of the day. So this is going to be an important point on what to buy in this rebound. Anyhow, it should also take away some of the flows that dividend-paying stocks were enjoying recently. And if you look at the Cokes, the PepsiCos, even the IYR real estate, again, they were the laggards in the morning. They only caught a bid because everything was getting bought at the end of the day. So this is really important in which stuff you buy right now if you want to participate, if you think that we have more upside to come. What stuff to buy and trade. This is really important. You don't want to buy the stuff that doesn't make sense, like the IWM or the KRE. These sectors were looking for 50. We're not getting 50. Likewise, the stuff that was going higher based on 50 basis points expectations, like the dividend-paying stocks, I think they dip more. I think more profits are taken from these names. So the question now becomes, as I said in the morning brief, where will the money rotate to? In the pre-market session, it appears that the big caps are the only stocks reacting positively to the CPI so far. Hard to say whether that will sustain toward the end of the day or not. Should it stick by the end of the day and we get bullish confirmation in the indices, then we'll have to change our bets to reflect bearish positioning against those sectors that were backing on 50 basis points, not 25, instead of the major indices dominated by the big caps. Again, this is the initial knee-jerk reaction, and a lot can change, but the drop in the VIX bode well for the market if it doesn't reverse as the trading open. By the end of the session, we will respect the technical confirmations by the market and trade accordingly. What I wouldn't do is make bets quickly upon the open without seeing how traders will react to the news first. This is really important. I don't say this stuff just to say it in the morning. If you followed any action, let's say in the first 2 hours or so of trading today, you got trapped because initially it was moving higher and you might have bought some calls. Then we got a reversal, a big flush down, and you might have freaked out and you took those calls out of the picture. And maybe you went with the puts. Oh my God, we're going to flush down now. It makes sense. And you might have get sucked in buying those puts, and then we got the short covering rally. So you got to wait till you get clarity of what's going on. What are the big traders and bettors doing? What are they thinking based on the data that we got today? And again, folks, since we got the confirmations before the closing hour, we've adapted and we decided to close some of the bets that we got, the bearish bets on the mega cap stocks. We had some butterfly spreads on Meta, expiration date September 20. That's way too soon. If we're going to go higher, then these butterflies will lose a lot of value. If you go another 2% higher, they're going to be worthless. So we got to do something about them right now. We closed the Meta butterfly, gains of about 20%. We could have made more. I wanted to make more if we were going to go down another percent or two in the next few days, but we got to adapt. Then we closed the Google butterfly. The gains here, 327%. Then we closed the Microsoft butterfly. This one, we got a loss of about 70%. Not pleasant, but again, if you put, let's say, 10 grand in each of these trades, you walked away a winner at the end of the day. Not fun to take the loss, but we have to adapt because whatever 30% I got in Microsoft, I can deploy that in a winning trade and make up some ground and perhaps profits to come. And I identified why. Look, the shorts will cover in a given day, and that's it. They'll go away. They want to take a break, perhaps come back later in the second half of September, where we usually see the seasonal ugliness of September. But what if the action today initiates some FOMO buying? That's what I'm afraid about here, that we see more buying tomorrow. And then all of a sudden we have a move that takes all of these puts that you got specifically for September 20 out of the picture, worthless entirely, because they're not going to hold value as the October or November puts. Keep that in mind. You might miss on a nice move to the upside here, maybe 1.5%, 2%, who knows. But we put in this note for everybody, all members, with 25 basis points confirmed and not 50 basis points, where we see the Dixie moving up but not bonds. Money has to stay in the market. They're not buying the dollar and bonds at the same time. I see profit booking from dividend stocks and some migration toward big caps. I don't think the dilemma of where to park the money right now has been resolved, because it doesn't make sense to park in the big caps, by the way. If we have 25, not 50, okay, IWM is not a way to park. Neither the KRE or the risk-on segments. Do we park in the dividend-paying stocks? They're already overbloated. They were banking on 50 basis points too. So where do we go? I think the market just decided to go with the big caps right now because that's the easy answer. Anyhow, but today's shorts decided to cover. We see that evident from the increase in volume and the VIX losing 20, all while the market technicals so far gave bullish confirmations. The SPY is above the 50 days moving average. The Qs above the 100 days moving average. My strategy: closing October indices puts until a loss of these confirmations happens first, and switching to some, here's the keyword, some bullish bets. I'm not going to be sucked in all the way in here, because I got more confirmations lines on when to increase my upside bets, and those are not triggered yet. Anyhow, with smaller amounts such as targeting the SMH 20 daily MA and Microsoft upper Bollinger Bands. The reason is after shorts are done covering, we might see sideliners finally stepping in and FOMOing the market until the cuts next week. That's really important, and it's a huge risk for holding bearish positions right now. Now the question becomes, okay, do I really chase NVIDIA after it's up 6% Maverick? Do I chase the Qs when it's already up 2%? Maybe, because that's what they're buying right now. They didn't find any opening elsewhere, and they went with the big caps. But if we have rate cut optimism, think about the stuff that's been getting hammered because of the recession fears. You gotta find something you like here. I'm not gonna buy anything I don't like and doesn't make sense to me, like the IWM or the KRE. They were backing for 50, now they're gonna get 25. Doesn't make sense to me at all. So if I bet to the upside on these names and then I lose money, I'm gonna feel stupid. But there gotta be something that you like here. Example, we opened some MOS 25 calls, expiration date October. This is Mosaic. You can see the chart battered, bruised. It's been hit really hard because of recession fears. Well, if we have rate cuts, wouldn't that alleviate some of that? And if we're now initiating the rate cut optimism period, the sugar high, until we get the actual rate cuts, and then we sell the news, I think it makes sense to at least play a rebound here. And you see it a lot in the energy names that are way oversold pricing in a recession. Can we get a little bit of a sugar high rally until the rate cuts and then see what happens? How about a chart like Zoom, daily chart? Looks like a bull flag to me, now breaking out, not overbought. Maybe you can play this for a little while here until we're done with the rebound. How about oversold, overbruised Octa with a falling wedge that is now breaking out? Maybe you like this guy. It's oversold, it's not overbought. Even in the chips, how about AMAT? Doing a double bottom for now. Can it at least go all the way to the gap where we see some resistance and then we come down, break the trend line, and initiate more downside? What I'm trying to say here, folks, you gotta find something you like. Because if it is indeed the sugar high period of buy the news or buy the rumor, and sell the news once the rate cuts happen, because the second half of September is where we see the ugliness showing up. Why? Because the buyback period stops. They can't buy back anymore. And I think that's where the short's going to come back in again. But what if between now and then we get another rebound of about 1.5–2% in the market? You got to have some participation in those. And at the same time, not assume the decay that will happen between now and then on your short positions. That's the point from today's notes. Now let's play the devil's advocate. What if today is just a throw-off? What if it's a trap? Will we wake up tomorrow and the all hell broke loose and oh my God, we closed our puts, Maverick, and now we're going down, or we bought calls? Is that a possibility? Yes. But from a technical perspective right now, looking at the confirmation lines, there's something you gotta use as a guideline. And I can't use speculations or possibilities or what ifs as my guideline. I only got the charts to work with. So I'm gonna trust the charts right now and trust the fact that the professional shorts, the whales, they did close today with higher volume. There's something that they saw where they thought, okay, it's not worth it to keep these bets right now. Let's book profits, come back later. I trust their judgment, so I'm not going to fight it, at least not right now. But what is the devil's advocate? Listen to this headline here from Bloomberg. It says bearish signals flash in risky parts of $9.5 trillion ETF market. What are they talking about? They're talking about the inverse ETFs. All of a sudden, we have volume showing up in inverse ETFs. And usually that happens before or during bear markets, during crashes and bad times in the equities market. Folks use these inverse ETFs to hedge their long positions. They use them if they don't like options at the time restraint. When it comes to options, they just like to buy and hold on an ETF. These inverse indices, like the SPXS, the SQQs, you know them, you're familiar with them. They've been getting flows. So again, it's part of the hedging. It's part of why we've seen the VIX going higher. And that could be a warning sign. If they continue to buy these, then the hedging is not over. And if we see the VIX rebounding above 20 again tomorrow, then the hedging is not over. Are we going to adapt? But again, folks, we got to have some guidelines to abide with. And I told you, folks, I look at the daily charts. I'm going to abide by the confirmation lines. And this is exactly what I'm doing today. Not fun to close those October puts at a loss, but at the same time, there's no point of holding on to them if they continue to decay with another 1–1.5% move to the upside. Why not participate in the upside if we have it for more days to come here, and then reinitiate the shorts again once we have a confirmation? And the last thing I want to address here, because I promised the viewer, you got a million asks. And by the way, I think I missed a few questions. I apologize, folks. On the Discord session, I think I missed the RBOB. So we're going to talk about in the commodities coverage. And I think I missed somebody was asking about the MACD settings for the intraday charts. So we'll do that when we talk about the charts analysis. But you got a minute to ask, but on the next video, mind diving, not crazy deep, into thoughts of Palantir joining the S&P, how adoption is typically performed, and personal thoughts for 3M. Now, if you're talking about 3M as in the company 3M, that's a dividend-paying stock, and it thrived under the assumption of 50 basis points cuts. But now that we see yields coming back up, this one will pull back a little bit because it's a dividend-paying stock. It's part of the value play. So not the time right now to buy it. You have to wait for perhaps after the cuts. If they switch away from the big caps and they look for safety again, then you see 3M going higher. As to Palantir, usually we see the inclusion in the Dow Jones or the S&P as the cemetery because we see stocks outperform until they graduate and then they hit the cemetery and then the performance stops. But between now and the inclusion date, what happens usually is we see buying. The asset managers, the retail traders and investors, they begin to position ahead of time in buying the stock to reflect the weighting in the S&P 500. Usually we see the outperformance of these stocks beginning after the inclusion date. So right now, I think we have, a few weeks before Palantir is officially included in the S&P, and that's when you're going to see the weakness. That's when you see a lot of folks who are bidding on Palantir as a growth stock getting out, because any problem that we have from now on, where they dump the index, the S&P, well, that's going to mean dumping Palantir too, and that's problematic for a lot of growth investors. And this is why we call it the cemetery. But between now and the inclusion date, not the right time to short it. You have to wait till after the inclusion date. And that is, by the way, typical of any stock. Just go back to Tesla and the inclusion in the S&P. We got huge buying all the way till the inclusion date. After the inclusion date, Tesla went down, and it's been consolidating in the same range for 3 years. So the cemetery of a growth stock is graduating into a larger index, unfortunately. But there are mechanical reasons of why that happened. Anyhow, folks, let's segue to the market information, beginning with the closing of the indices today. And here we go. The diamonds in the green, even though it was down about 700 points in the morning. And that tells you right away that the shorts were just covering all over the place, on the index levels all over the place. So it even managed to lift the Dow Jones and the Russell 2000. So we see the Dow Jones in the green, 124.75 points, or a gain of 0.31%. And the Nasdaq leading the pack because the majority of shorting happened in the Nvidias of the world, the big caps of the world. So we see the Nasdaq up 369.65 points, or a gain of 2.17%. The Spider also in the green, 58.61 points, or a gain of 1.07%. Now the Russell 2000 small caps, the laggard, along with the Dow Jones, because it doesn't make sense at all, based on 25, not 50 basis points. But the short covering, the algos, picked everything at the end of the day. And we see the Russell closing in the green by 0.61 points, or a gain of 0.29%. Still the laggard of the day. When we look at the sectors, technology at number one, that's where the majority of short covering took place. Nvidia, of course. Cyclicals, we're talking about Amazon, Tesla. We're talking about a lot of names that were shorted. Now we see covering of those names, so that comes in number two. And comm services, Google, Meta, also shorted. Now we see some covering showing up, and that's performing too. Metals, lots of short covering. But the difference between technology and metals was getting hammered because of recession fears. If you introduce the rate cuts, be it 50 or 25, you introduce relief that is more sustainable. And the same can be said about energy, by the way. But we have to see more of that before we jump into energy. Matter of fact, I would say wait all the way till the cuts are actually in before we buy energy. If you want to buy right now, just open via increments. Now, we see some of the defensive sectors like utilities, dividend paying, also doing okay. But if you look at the details, which we're going to do in a minute here, when we look at the heat map, the risk on segments of utilities were the leaders today, not the defensive ones. So keep that in mind. And then you look at consumer defensives. That's where we see the dividend paying stocks, the safety, the Cokes, the PepsiCo, the Procter & Gamble's. That's coming at the bottom again. It's just money coming out of it. They're not hating it. They're not shorting it. They're not hammering it. So the pullbacks at some point in consumer defensives and the defensive dividend-paying sectors of the market will be proven as a buying opportunity. Now, when it comes to financials, of course, this sector has its own problems right now, its own fears with JP Morgan, Goldman Sachs, the triple warning that we got yesterday. So for now, if you're going to buy the dips again, maybe you'll be lucky and have an oversold rebound in Goldman Sachs or in JP Morgan. But don't buy something that doesn't make sense to you. Only buy stuff that makes sense to you, based on the 25 basis points cuts, not the 50. Looking at the breadth, believe it or not, it was just neutral, even though we have a 2% plus upside in the NASDAQ. The breadth was 50 to 49 in the NYC, advancing to declining. The same in the NASDAQ, 50% advancing, 47% declining. We have more new 52-week lows versus highs. So again, the breadth is not really that good. And that tells you right away. The majority of the gains came from the big caps, the most shorted names, because the shorts, for whatever reason, decided to say, okay, you know what? We made enough profits. Let's book them right now and wait for a better entry again. Looking at the heat map, here it is. You see right off the gate, the majority of the gains concentrated in the big caps, in the software, but primarily in the chips, the most shorted, NVIDIA, Taiwan, AVGO, AMD, ASML, everything that was getting hammered. Now we see the shorts buying back and pushing higher. Where are they booking profits? Look at the dividend-paying names in healthcare, the defensives, J&J, AbbVie, the medical devices, the insurance names. All of these names were thriving. Now they're booking profits from them. Look at the industrials, the defense contractors, Raytheon, Lockheed. That was their resources safety. Now they're booking profits from these names. Look at even utilities. What's outperforming? It ain't the northern part of utilities, the Dominions, the Duke Energy, the dividend-paying safety. It's actually the southern part of utility where we see more risk-on segments. And the same can be seen in real estate, the classic safety, in public storage, in PLD, in American Tower. They're actually in the red today. What's outperforming though? The medical properties, the office REITs. They're not reliable. I would not chase these rebounds at all. They're taking profits from the staples, Procter & Gamble, PepsiCo, Coca-Cola, Philip Morris, GIS, General Mills, all the names that were thriving under the recession fears and expectations of a 50 basis points cuts. Now, I want you to look at cyclicals, the home builders, D.R. Horton, Lennar. Those were going higher based on expectations of 50 basis points. We're not going to get the 50, so here we see money coming out. McDonald's, the outperformer in the last few weeks. Now we see money coming out. AT&T, the performer last week and so far this week. We see money coming out. And the same can be said in financials, the insurance names, the Chubbs of the world, Travelers, Berkshire Hathaway. They're taking profits from these guys. Now we see rebounds in JP Morgan, Goldman Sachs. Not reliable. Not going to be my bet here. But the message is clear. Initially, the market decided to say, okay, what sectors were pricing in 50? The good and the bad. Those we're going to reverse. So if we're buying Procter & Gamble because we're expecting 50 basis points rate cuts and we want to go with dividend, now we're going to take some profits out of that. If we were pricing 50 in the regional banks and now we're getting 25, that doesn't make sense anymore. I'm taking the money out. But in the mid of the day, as the day progressed, here comes the short covering, specifically in the chips and in the big caps, and it lifted the market altogether. Whether that's going to last in tomorrow's session or not, we don't know. But if we get a follow-up, yes, it's going to last. And that's a lot of risk to continue to hold the shorts against the chips or the big caps for now. Until we lose the bullish confirmations, we got to stay disciplined here, folks. Looking at the heat map for the ETFs, TLT was flattish because yields did a rebound now that we have to price in the 25, not the 50. And you see the risk-on segments from yield sensitive like the IWM, the XRT retail, the XHB home builders, the ITB construction, the XBI Biotech, the KRE regional banks, all underperforming today. The XBI is in the green because of NVO. It's a huge weighting, and we got some good news because of the pills today. That's why it's higher. But the majority of biotech was down today. Do we see the defensive, yield-sensitive performing, though? Not really. XLP down, XLU down, IYR, the XLV, all of them are down. So when the money's not going to go to either the defensive yield-sensitive or the risk-on yield-sensitive because rates are going higher, where do we go in the market? Gold makes sense. Silver makes sense. Some of the commodities make sense. So we see the USO going higher today in a rebound. But if bonds are not rallying along with the dollar, money has to stay in the market somehow. And they decided today, sure, let's stay with the big caps then. They went down the most. And we can't go with the dividend-paying names anymore, at least not right now. We can't go with the risk-on IWM and the KREs of the world. So The shorts figured out, you know what? What if we have a rotation to the big caps, the Metas, the Googles, the Amazons of the world, and the chips? Because those were the laggards. That's where the opportunity is. They've been hammered since the beginning of the month. So why not be safe, book our profits from the shorts, and wait for a better opportunity? I think that's the summary of the day. Let's move on to commodities. Now we're getting the 25, not the 50. Still good enough for crude oil, because crude oil wants cuts of any sorts. Crude doesn't care 25, 50, give me something, give me some cuts, because I've been pricing in a recession. And by the way, overshorted in way underpricing the reality of the oil market right now. We got fundamental news from the supply side indicating oil should be higher. And I promise you, we will see a big short covering rally in oil. Even the gasoline RBOB, by the way. But for the viewer who asked about the gasoline RBOB, you can buy the gasoline RBOB, but be careful about the refineries, the VLOs and the MPCs. And the reason is, if crude oil outperforms RBOB, the refiners are not going to do pretty good because the refiners want to see the RBOB outperforming crude. So that's the caveat you have to be aware of. Now, when it comes to nat gas, it's in the green too, but we've noticed before, if the trader's going to go back to short covering in crude and perhaps buying some crude from this point on, betting on the rate cuts, 25, 50, doesn't matter. Will that take away some of the flows in nat gas? Because it did outperform crude while crude was crashing. I think that's a possibility. So if we see more gains in crude tomorrow, then I think money will come out of nat gas. Now, when it comes to commodities, we see big moves higher in cocoa, up above 6.5% for the day, cotton above 2%, OJ, although the laggard, down about 4%. I think OJ is looking for a breakout, though. We'll look at the chart again. I don't want to go too heavy here, buying commodities before the actual cuts, even crude, by the way. I'm okay with opening a little bit in the stream today. I said open a little bit. If you must open just a little bit in the USO. But we're not going to see the sigh of relief completely until the cuts are already in. We see lumber, sugar going higher. When it comes to metals, we see more of the risk-on metals, like copper, silver, platinum going higher, while gold kind of holding steady Eddie, the flat line. Now we see palladium with a huge move higher, over 6%. Why? We got some news from Russia that President Putin is planning to restrict some exports of strategic metals like uranium, titanium, and nickel. And of course, palladium comes with that. Russia is a big producer of palladium. It goes into chips, so we see palladium higher. And by the way, lithium went higher today. Nickel prices went higher today. Uranium plays like UEC or Cameco went higher today because of these restrictions. Now we see mixed action in grains, soybean oil down, but soybean meal up and wheat up. We're not going to go deep here buying commodities until the cuts are already in, folks. What about the big casino options? What do we see here? The volume is still shy, but it is concentrated in NVIDIA and Tesla. Lots of volume showed up in NVIDIA today. A lot of it, of course, is buying calls. And this is, by the way, this is just standard procedure by the shorts. When they cover their shorts in NVIDIA, usually they buy the puts because this is how you cover your short. You have to buy whatever you shorted. You have to buy it back. So they buy some calls, upside calls, if they expire in the money. They have the option either closing at that price or as they exit the short and they push the price higher, they make money on the exit too via buying these calls. It's a smart strategy by the shorts. And this is why we see the volume going higher, but we see the ratio moving up toward calls, not puts. Now, the good news for the bears who are maybe upset that they had to close some of their bets today, look at the IV ranks. The options are still really cheap. Put options way too cheap. So if we get a downturn again in the second half of September, whatever rebound that's going on right now, say it fizzles out, you're going to have a really good opportunity to structure right now. What's not fun, though, is opening those puts late in Friday's session last week when the implied volatility was high and watching the value decay as the IV rank goes down. That's not fun. You want to do the opposite. You want to begin the position when the IV rank is low and you want to enjoy the increase in implied volatility. But the entry is also important. You gotta have a reversal confirmation from bullish back to bearish before we do that. Let's look at the flows. This is the net flows, not the buy, not the sells, all together here. Bullish flows for Apple, for NVIDIA, for Google, Boeing, AVGO, AMD, Microsoft, Walmart. We see bearish flows in the indices, lots of hedging showing up at the same time, the SPX and the SPY and the Qs. Google remains the black sheep of big caps, but it's getting attractive there, oversold, maybe due for a rebound. We also see negative flows in Coinbase and bonds and Oracle, Adobe. Adobe has a report coming out tomorrow, so that's really interesting. Let's do the unusual activities, beginning with the bullish. We have Tesla, jittery. Tesla, something is going on. They keep buying these huge calls. So a lot of you want to short it, but I want to know what's going on here. With $40 million worth of calls last week, we continue to see these calls showing up. Maybe they know something that we don't, but who knows? Here, they bought the 222.5 calls. The expiration date, September 2024. They paid about a little over $1 million. Here we have another bullish one for Apple. They bought the 202.5 calls for the expiration date, September 20, spending a little over $1 million. By the way, one of the few bearish trades on the big caps that I kept open is the Apple trade that we talked about just, a couple of days ago when we got the release of the iPhone. That's okay because it is close to the money and we don't have a bullish confirmation in Apple. So that's the only one I'm going to keep right now. Let's look at another bullish one here for the SOXL. It's a short put. They sold the 10 puts with the expiration date of Jan 16, 26. They don't think that the SOXL, this is the ultra leveraged, the 3 times bullish on the SOXX, the chip index. They don't think it's going to go below 10 by Jan, and they netted a credit of about $2 million. Now, the beauty of these credit plays that they do, even if they're wrong and we see the chips going down and the SOXL going down, by the time we see decay, they can close the trade but book the difference. So now they credited 1.8 million. Maybe they can close it and buy it back at 1.5 million, but they're going to pocket the difference. And that's the beauty of selling options. You're now in the seat of the market maker, but it requires a lot of margin in your account. So most of us cannot do it. Let's do the bearish flow. And we have IWM, bear put spread. They bought the 198 puts and they sold the 195 for the expiration date October 18th, spending about $2 million. That comes as a confirmation of what we talked about. The IWM has absolutely no reason to rally right now, since we're getting 25, not 50. And here we have a very bearish trade against the IYR. Dividend-paying stock was pricing in 50 basis points cuts while it was rallying. Now we're getting the 25, so somebody bought the 90 puts. They sold the 85 for the expiration date Jan 17th, 25, spending about a little over $1.5 million. And then we have a bearish one for Etsy. They bought the 45 puts for the expiration date June 20, 2025, spending almost $1.5 million. I remain short this name. I've been shorting since 21, I believe. So I'm still paying interest in this guy, but it just keeps going down. So I never had the opportunity to close it, really. And then we have IBB, NASDAQ Biotechnology ETF. This is a big one. And they bought the 135 puts and the 130. The 135 for the expiration date of October 18th. The 130 for the expiration date December 20. All in all, spending a little over $9.5 million. It goes hand in hand, by the way, with the IWM. Biotech needs 50 basis points cuts and perhaps more. Without that, we can't really play with it. The beauty with the IBB versus the XBI, by the way, the IBB is more concentrated in the smaller biotech names. It doesn't really include the NVO, which shouldn't be really included in biotech, to be honest with you. In Regeneron, the higher quality names, the IBB is more concentrated in the smaller biotech names. Let's do the charts and then wrap it up. We begin with SPY, the S&P 500. Look at the momentum indicators, RSI, MACD, all giving us bullish confirmations. A little excessive today, sure, but it has the markings of short covering. And the fear, of course, is the FOMO crowd comes out tomorrow. You could see more gains to come. All I know right now is we closed above 550. That was my bullish confirmation line on the hourly chart. I'm going to abide with it. I'm not going to be cute here. And be stubborn. No, we're going to go down. So what is the point of... maybe we're going to go down later on. What is the point of holding the decay right now? If we're going to go down later on, okay, when we break some supports and we have better confirmation, I can re-enter the trade again. It's not going to fly away from me. I can always capture it again. And by the way, the daily settings that I used in the SPY and the MACD, here it is, 24, 60, 12. Some folks love to use the 24, 52, 14. But again, general practice here. I don't want to give bad advice. Usually we don't use that. Okay, it's just going to confuse you because now you have to look at other charts and how they look and all of that, and you have to have individual settings, which I have. I write them down and I have my individual settings for each chart. I just use it as a confirmation, as a second look. But the algos, the majority of traders, they use the daily settings in the MACD, and we have trained our eyes throughout the years to use the daily settings even in the short-term charts. So we're going to abide with that for now. Looking at the daily chart for the SPY, the 50 was my confirmation line. We closed above. You gotta abide with it. We closed above the breakdown candle that you see back in the beginning of September. So right now, we have a confirmation of a bearish to bullish reversal, which reverses the odds to 70% risk to more upside versus downside. Now, look, if we lose the 50 again, I'll be the first to come back here and say, you know what, let's go back to the bearish trades again. But I don't want to assume the risk if we have more follow-up to what we got today. I gotta stick with my confirmation lines. Any resistance we got right now, sure. Plug in the Bollinger Bands and the 20 days moving average in white, but we stopped short of the 20. So if we close above the 20 tomorrow, it'll be more for confirmation that we have more upside to come. Now, if we have a rejection off the 20 and we lose the 50 again, then we're back on track with the bearish trades. No harm done. Looking at the E-mini futures daily chart, once again, we're above the 50 days moving average, so we have confirmations even in the futures chart. The next step here, if we draw a sloping line of resistance, we can still maintain a bearish pattern by the way of lower highs. But what if we have more to come here, folks? What if we go all the way to the sloping line and then we find resistance? Your puts would decay by a lot at that point, and you're going to miss on upside to come. So that's all what we're doing right here, adapting based on the confirmations that we got today. That could be, by the way, gains of a little over 1.5%. If we beat that, then we can talk about the upper Bollinger Bands. But one step at a time. September is hasn't shown, let's say, its full ugliness yet. Looking at the Q's hourly chart, what do we see here again? Similar with the SPY, you see a lot of volume. That's short covering. Green candle after green candle has all the markings of short covering. Now we can look at it as a rising wedge, and it's too excessive, and down we go. Got it. But we're above my confirmation lines on the hourly. 453.81 and 461.22. I'm going to abide by my guidelines. In the daily chart, are we above or below the 100 days moving average? We're above. Are we above or below the top of the breakdown candle? We're above. Okay, we got bullish confirmations. Let's play with them. I don't know, maybe we'll stop at the 50 and then we go down. But even if we go down, we're not shorting again until we lose the 100. If we cross above the 50, then we have more gains to come. We have to talk about, for example, the upper Bollinger Bands at that point, but it's way too far. I think one step at a time. The point being is, since we got bearish to bullish confirmation today, even though based on short covering alone, which is not a solid reason, but it could trigger more buying. And we have to abide by the rules, folks. The IWM small caps pierced below the 100 days moving average, but caught a rebound from the lower Bollinger Bands. Again, I think that the IWM is the weakest of the bunch here. If it loses the 100 again, I'm going to stick to being short the IWM. And this one doesn't have any bullish confirmation until it closes above the 50 days moving average, and we're not close to that number yet. The dollar above the 20 days moving average and showing a higher low pattern. If the PPI comes out hotter again tomorrow, then the Dixie will continue to move higher. Implications on the Japanese yen. By the way, the dollar came as a rescue because the Japanese yen was going above the highs from August overnight, and you saw the Nasdaq futures going down. But then came the savior because of the CPI, and the dollar held ground. And we see right now the danger from the Japanese yen being halted. What does that do to gold? Gold is steady Eddie right now. It's not really moving erratically. Even if the dollar goes another, let's say, 0.5 percentage point higher, it won't be a massive drop in gold. It will be a pullback that everybody would love to see to buy more. So we're going to stay steady Eddie here in gold. Of course, the gold miners GDX will be more sensitive, so you're going to wait for more confirmations until the dollar goes down before you go along the GDX. Now, when we look at the SLV silver, I'm not liking it here. Still below the moving averages, 50 and the 100, 50 in blue, 100 in red. I'm going to stick with gold and use SLV puts as a hedge against my gold position. What do we do with crude oil? Got a nice rebound. Oversold, due for a rebound. Got it. But it needs the cuts to be already in to sustain in a rebound. So right now, if you're going to buy crude, just start small. Tiny little bits. I know if you look at charts like Oxy and Exxon and the USO and the SLBs of the world, they're way oversold. I'm with you. And maybe you should initiate some beginning of long positions. But they're not going to thrive until the cuts are already in. Looking at the 10-year yield weekly chart, we see a little tick higher, keeping the trend line intact right now because we're pricing in 25, not 50. Of course, we have PPI, and the next week we have retail sales. My 2 cents, with a drop in gasoline prices, folks, the retail sales data next week will be weak. And it might revive the 50 basis points cuts. And at that point, it might be looked at as bad, or it might be looked at as, okay, the retail sales data says 50, but the Fed will do 25 because the Fed is not going to pay a lot of attention to the retail sales. The Fed is going to look at the jobs report and the CPI data, and those merit 25, not 50. So again, I see an upset coming next week. But between now and then, we could see the sugar high of the possibilities of rate cuts, be it 25, 50, doesn't matter. Looking at the XHB Home Builders daily chart, the bear flag did play out. We got a nice whack in the morning, but then again, they bought everything at the end of the day because of the short covering, and we see a bit of a recovery here in the XHB. I'm not buying it though. I think that the XHB is weak, and if we have 25, not 50 basis points, then you can't lower mortgage rates enough to revive buying activities in housing. When we look at the IYR, initially it went down, losing 175, but it came back up because we bought everything at the end of the day with a short covering. I'm not buying this one. If anything, I would say if the action that we got in the big caps and the chips continue to go, we might see more money coming out of the IYR. Looking at the KRE, below the 50, so still bearish, and it doesn't make sense at all right now with the 25, not the 50. Sure, got to bounce like everything else today, but we're going to stick with the bearish outlook here. 55, 53 puts, or the 53, 50, whatever you like. I think that the KRE has more downside to come. The VIX, part of the confirmation that we use, it went all the way down to 1760. It doesn't say that we're out of the woods, but it say that at least for now we can take a break from the threat of selling. We can catch some momentum to the upside, but we're not out of the woods completely. And I'm still in the camps that we have higher highs coming in the VIX in time. Looking at Apple, what do we do here? The big kahuna is below the 50 days moving average, so it's the only one without bullish confirmation, and this is why I'm keeping my puts only in Apple right now. If we close above the 50, then we have something else going on. But right now, we're below the 50, so I would say in time, it's going to find its way back to 215. Tesla souffle above the 50 again. Do you go with the calls that we've seen yesterday and today and last week? I'm not there yet. I got to see a close above the top of the breakdown candle. You know why? Because if you plug in the Bollinger Bands, they're really tight right now. I think the upside is limited, and the downside is limited too, but it has more room if we close below the 20 days moving average. So right now, if there's anything that I'm interested in Tesla, would be perhaps the 220, 200 puts, but I'm only going to do that if we begin to lose the 20 days moving average. Nvidia, above the 100, sure, so we got one bullish confirmation. The next resistance becomes the 50 in blue. If we lose the 100 again, go back and place your puts in Nvidia once again. But right now, you have a lot of risk that we could see a follow-up when we close above the 50 and we see another stampeding going on. Looking at the hourly chart, we talked about 110.90. Must recover and hold. It did recover and held. I know the pickers would say, but it's a rising wedge, Maverick. Down we go. Got it. But so long as it's above 110.90, I got no short thesis here. If it goes below, I'm going to place the shorts again. Right now, you can get a pullback all the way, let's say, to 114, then find buyers again. And higher we go. Bitcoin tulips weekly chart. What do we do here? At the 50 weeks moving average, didn't break below, so there's nothing we can do here. MicroStrategy was ugly in the morning, down about 5%, but it did recover a little bit at the end of the day. I'm waiting for that break. Without it, there's nothing for me to do in Bitcoin here. Let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? We got the PPI, baby, Producer Price Index. Can it change a lot from the CPI? Only if we have a big surprise. If it is a downside surprise, it ain't going to change back to the 50. We still got 25. The actual risk here is if the PPI comes out with a massive beat to the upside, then we can talk about, okay, let's panic, shit our pants, and reverse the entire move that we got today. Otherwise, the PPI will be another piece of input data that we're going to consider and then ignore. We also have initial jobless claims. The next important piece of data comes out from retail sales. That's coming out next week. And of course, the FOMC decision. Folks, once again, I thank you for joining me tonight. And I love all of you, appreciate all of you. And I hope that you're finding this content informative. But this is all I got for you for tonight. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
Hi, Ray. Aren't, you supposed to be in bed?
Yeah?
Yeah. I won't tell.
But your thoughts will soon be wandering the way they always do. When you're riding 16 hours, there's nothing much to do. And you don't feel much like riding, you just wish the trip was through. Here I am, on the road again. There I am, up on the stage. There Smoked the day's last cigarette, remembering what she said.